Good evening, everyone. My name is Mohit Bhatnagar, and I welcome you all on this interesting sessions on the markets by Quantum Mutual Fund. We thought that it is very pertinent and a good time to understand from our fund managers and share our perspective with our distributor partners about what is happening in the equity market. Last 6 months have been a very, very different trajectory and path that markets have been following. And there is certainly an environment of uncertainty and obviously a lot of rumors, lot of news flowing around, and definitely not everything is making sense. So let us try and understand today what are the fundamentals which are basically looking good. At the same time, what are the opportunities which will be available in next financial year for us, along with the challenges which are currently visible to all of us. So to understand our view, we have invited two of our senior fund managers, Mr. George and Christy. Both George and Christy are responsible for managing our value style of investment, which is value fund from Quantum, which is our flagship fund. Apart from that, they also track the markets very, very closely, talk to let out a lot of FI clients, domestic institutions, and have a very, very fair idea about what are the challenges and opportunities which are available in the market. So with this, I hand over to Christy to share his views on the market. And at the end of the session, we have two main goals to achieve. One is that how can we share our perspective, which can be some confidence building measures amongst your investors, and at the same time to make you aware about some opportunities which we need to keep an eye on. So without much ado, I would hand over to Christy for his presentation. Over to you, Christy.
Right. Thanks a lot, Mohit. Hope I'm audible. So I'll just start with market positioning and how what is the outlook for markets if you were to just think about a year out. So these are possibly very fascinating times if you were to look at the drawdown that we have had in the past few months. So if you were to just look at the Sensex itself, which is a very narrow index, very large capish. So as of Feb end, the correction that we have seen is close to about 13% from the October highs. And this does not really tell you the whole pain that has happened across the markets. So if you were to look at the very large subset, so this is close to about 4,000 odd companies. And if you were to just look at that as a superset, and you see about 79% of them have fallen by about 30%. Now that is quite large. And if you were to just look at the BSE 500, which is the SEBI-defined index for us, and within that, as you all know, the top 100 companies are large cap, 101 to 250 is the mid cap, and then beyond that is small cap. So the pain is particularly evident is in the small cap space, which is close to about 40% decline on a versus a large cap close to about 25%. So this is all that you guys know. And coming to the very important point on flows, so we have seen a record FI selling close to about $21 billion in the past few months, and this is one of the highest that we have seen for quite some time. So we don't really know when this money will come back and what form of fashion, how quick that is. It's very difficult to think about FI within that context because there are a lot of things that they'll be looking at. For example, they might be looking at the globe as a whole. Within that, India would be close to 2% of their allocation if you were to include the developed markets also. Some of them would be looking at emerging markets. And within that, Indian allocation could be as high as 17%, 18%. But what is particularly of interest to us is the MF flows, the insurance flows, everything put together, the DI flows that we have seen. So this is particularly with respect to the MF flows, which have been particularly strong. Even the latest numbers looks like it's pretty good. But what is often forgotten is the period that was following the global financial crisis, which is 2008-9, what we have seen when the numbers were looking bad, as we all know, the market fell down and then it recovered quite handsomely. But then the intervening period after that were not so great. And people were looking at their portfolios, and many of them would have invested at the peak or done some wrong asset allocation. And when they look at their portfolios end of those 3 4 years, we have seen a lot of redemption that happened, close to about 4 billion redemption across that period, almost, which lasted for 4 5 years until the Modi wave that kind of took off. Post which we have seen large part in terms of you know allocation towards MF as opposed to any redemption. So this is one question that we keep asking ourselves: how would be the domestic investors behave, especially in the environment that we are in? Right. Now, where has the flows gone in? Now, again, this is something that you would all track. But if you were to look at the large part of the flows in the domestic mutual fund industry have fallen, have gone to mid and small, if you would just look at the recent data. Now, this comes in a context of the valuation being higher on the mid and small cap versus the large cap space. So if you see the differential between the valuations versus mid and small, large cap probably trade at about 18.73 trailing multiple versus the mid cap index is close to about 24 times. Now, small cap to get this P is very difficult because some of them are loss making. So that number will not tell you a great deal. But the broader index is, which is mid and small, is at a premium despite the correction that we have seen in the recent past. Here is a very interesting chart which tells you how, we all hear the term that, uh, you know, the stock is rather a slave to the earnings. The stock returns are a slave to earnings that would, that has happened in the recent past. And if you broadly were to look at how the market cap has behaved, so here we are just taking the BSE 500 companies, again dividing it as how SEBI defines it, the top 100 being large cap, 101 to 250 being mid cap, and thereafter small cap. So if you see the market cap composition of the large and small, we are at a point in time looking at one of the lowest market cap allocation to the large cap. So if you see in 2005, the large cap allocation within the whole market cap was around 75%. Now that is possibly at the lowest, 65%, whereas the small and mid, the market cap composition possibly is at the highest, close to about 35%. Now, this comes at a backdrop of low profitability. But if you were to look at the profitability share of the large cap within this mix, it is possibly at its one of its highest, 59%. And small and mid is possibly at its lowest. So here we are looking at your profits are possibly at the lowest in the small cap, small and mid cap, the whole spectrum, whereas the market cap is the highest. And that is converse with respect to large cap, right? So that tells you a story of how we are possibly looking at. So one of the worries that we have, I just showed that, the flows chart wherein a significant redemption cycle happened after GFC crisis. If you were to look at the past 5 years, especially what has happened after COVID, we have seen a record number of folio additions, close to about 50% new folio additions. And many of them, we don't have data, but many of them would have come through, looking at certain apps, directly investing into equities, where we doubt whether they would have followed any good asset allocation framework, to invest. So when they are looking at possibly one of the redemptions that is happening, or possibly 1 year return taking negative, we don't know exactly how they'll behave. So that is a question that we have to wrestle with going forward, especially in the backdrop of when the FI selling is so fierce, right? But that's about flows and how we see the valuations. But where are we seeing the earnings now? If you look at the BSE Sensex index, possibly it is, which is largely large capish. We see the valuations are near about its historical averages. Maybe some pockets are expensive, but by and large, it's near the averages, right? So if you had come to us and, maybe 6 to 8 months back and, possibly our view at that point in time was, you should be, we were not so gung-ho on the markets back then. And as a result, you saw our cash also built up because 6 to 8 months we were selling out of a lot of positions which were hitting our sell limits, in our portfolios. And as a result, the cash had built up quite a bit. But in the correction that we have seen, we have deployed quite a bit. And we think the valuation by and large have corrected, especially in the large liquid space. And one of the other things that makes us positive is the earnings trajectory. So this is a very busy slide, a lot of data points, but it tells you how the earnings have trended across the years. So, case in point, if you were to just look at the earnings in FY16-17, so we have something called sell side analyst, all the consensus, who will predict how each year earning is supposed to pan out. So, starting FY16, so some of them, as you would see, when they were projecting what the year will pan out to be, they projected very high numbers. We thought the economy is doing great and the earnings would come through. But as you go through the year, you're looking at how the company is performing quarter on quarter wise. You are getting a feedback on how the ground reality is. They have downgraded their numbers quite aggressively. So, case in point is FY17, where they started with almost 2000 as their EPS estimate. As they go through the year, that number is close to 1500. So that is a dramatic drawdown that has happened in the dramatic cut that has happened in the earnings for according to analysts. But post COVID, we think that earning down cycle has kind of moved up, changed, and we are possibly in some of the cyclical earning uptick that we have seen in the recent past, where the earnings have got upgraded. So earnings is kind of become better. And the rally that we have seen in the markets, while some bit there is valuation fraud that has happened in pockets, but more or less we see earnings supporting that valuation, which is always a good thing. And this is another representation of how that earnings have panned out. So if you see this whole spectrum of 2015, 16 to 2020, the earnings barring 1 year, which was low base, it has been pretty bad, mostly negative, flat. But what we see in the past few years, the earnings have trended better. It has been strong. Now, so there is a lot of noise that has happened, especially with respect to earnings. Also, if you were to just look at the past 2 quarters, we have heard so many news flow that the earnings is not so great across the industry, right? There have been dramatic earnings cut that has happened in certain pockets. But if you were to think really long term and look at a 10, 20-year period, what has happened is if you give that time frame, what you've seen is the earnings have compounded close to about 20x over a very long period of time. So there could be a near-term volatility. Case in point, we looking at the past 2 quarters, the first half has been pretty bad, right? And in fact, the 9 months for a lot of companies have been bad. But that does not tell you that how the next 2 years is going to be. It could be a cyclical downturn that we are seeing, and we know a lot of factors were there was this whole election that has happened. There was state spending and central spending which was curtailed. So some of those factors feed into the earnings narrative, and as a result, the earnings were subdued for the past 3 quarters. But going forward, we think there could be a normalization in that, and things should move up. If you were to look at long term, then you should just ignore the noise that has happened in the 6 to 9 months. The profitability compounding is pretty good when you look at in India. This is another chart, as I told you, that the stock returns in a way are slaves to earnings, right? And this is a beautiful chart that tells you how we have just rebased the BSE Sensex returns and BSE earnings to 100, and we are just tracking how it has moved over the years. So we see a very tight fit between what has happened in terms of the stock returns over a long term and how the earnings have compounded. So in a way, we all know the story that India GDP growth, real GDP growth, has over a very long time been 6.5. There is 5% close to about nominal inflation, inflation that is there. So you look at the nominal GDP, it is about 11%. And if you were to pick good companies which are listed space, ideally that compounding should be higher by at least by 2 or 300 basis points, which is where the index returns are over a very long period of time. And this is a very beautiful correlation that you see between stock returns and how the earnings have trended, right? So with that said, a person, especially advisors like you, can have a style bent where you would want to go the value way or the growth way. You might choose between different mutual funds, but Quantum is very clear in terms of what they want to do. So there are three filters for us very quickly. One is clearly we do not want any corporate governance issues in our portfolio. So typically we see some of the exposures towards sectors like real estate, some names in energy bucket where we deem corporate governance to be suspect. There would be absolutely no allocation to those sectors, right? Liquidity is very important to us. So we always have the trading volume and hence the large cap liquid bias that we have in our portfolio. Valuations is also very important to us. So if you see our portfolio positioning, we have not had staples allocation for a very long time, purely on valuations. We think some of them are very great companies to own, but we would want to buy them at a decent valuation, what we think is reasonable. So we have not had. So by and large, our positioning largely lies in the banking space, the auto space, and the IT space. There is close to about 12% cash, which we should be deploying fairly aggressively as new ideas come to come near. So with that, I'll just hand it over to George, who would talk us through our flagship products that we have, Quantum Long-Term Equity, and some bit on ELSS. So over to George.
Thanks, Sri. So I'll just take you through the broad asset allocation where we believe and the fund which I'm going to talk about in the next few minutes. So when you have an asset allocation, you can have a mix between equity and another asset class. And the fund which I'm going to talk about, the Quantum Long-Term Equity Value Fund, is something which can be the base of your equity allocation. And I will take you through the process, how we attain that and the outcome which we have achieved over the last many years. So being a value fund, we always strive to buy the stock at a discount to its intrinsic value. So suppose if I assume a stock A to be 100 rupees based on its true value, based on its fundamentals, what I'm essentially trying to do is to buy the stock at least 75 rupees so that I make a gain of 33% over the next 2 years. And what it means in terms of compounded return is 15.5%. And if we turn out lucky, it could be 100 pips higher or 1 percentage point higher if the real numbers are better than what we assume. And like Christy said, in India, from a nominal GDP growth perspective, it could be about 11.5%. And the index could be 200 bips higher than that. And this process would ensure that we earn slightly better returns than the index without assuming a risk which could be similar to index or any other random basket of stocks. So the outcome of what we have done over the last many years is two things. One, for every stock, we have an upside limit on a 2-year basis. For instance, if I believe a stock A is at 100 rupees today, and if that stock would be 132 years down the line, I would have a chance of making 30% return over the next 2 years. And if I have a chance of making 30% return, and if that is a 10% allocation in the portfolio, 30% multiplied by 10% gives me a 3% return at the portfolio level. And if I add all the individual potential returns of all the individual stocks, I would get the potential return of the portfolio. And this is a line where we have plotted right from the inception of this fund what could be the 2-year forward NAV of the fund. And like you can see, it has been more or less a linear line, except dislocations like COVID, which happened in March 2020, or the global financial crisis. And the blue line is how the line has actually panned out based on the actual returns of the fund. There has been 2 instances where we have seen sharp decline. One is in the case of global financial crisis, the other is during COVID times. And if I were to superimpose both these charts, the trend looks a fairly close fit across most of the periods. But has there been periods where there has been deviation, yes. One was global financial crisis. In November 2007, 2006, if you had come to us and asked what could be the potential return in an ideal world where we are allowed to make disclosures, we would have told you we would have made a 20% return over the next 2 years. But the actual number came out at a negative return. It was around negative 17 or 18%. Similarly, during COVID time, in March 2018, we would have told you there is a chance of making positive return, but the actual number came to a negative number. But the beauty of this chart is over long term, it has tracked very well and it has got back to its intrinsic value estimate in a span of 2 years. So over long periods of time, the process has worked phenomenally well, and that has enabled us to meet the return expectations which we had. And of course, that has been better than the index. So this is a broad portfolio construction process. Like Christy briefly explained, there is an integrity screen where we weed out companies with bad governance and companies which makes cut in terms of valuation or which makes sense in terms of their long-term valuation bands. Those form our coverage universe of about 200 plus companies, and roughly about 25 to 40 stocks get to portfolio. Mostly it hovers around 30 stocks. So, and there are 3 broad filters which helps us in terms of covering those stocks or getting them into the portfolio. One is the integrity screen. When Ajit met a gentleman in South Africa, and so before he started off his business, the advice which he got from the gentleman was, when you shake your hands and get it back, count the number of fingers. And if not all the 5 fingers get it back, you don't engage with that person again. It's the same philosophy which we have incorporated in our research and the companies which we cover. So any company which acts against minority shareholders or has siphoned off money to the founders and not distributed it among all shareholders, we would avoid all of them from the coverage universe. Coverage from the portfolio, definitely, and some of them we might cover just for an understanding perspective. And this proprietary integrity screen has been incorporated by the sponsor right from 1996. It's a long history. It's a long period of evaluating companies. And since 2015, we have enhanced that integrity screen to cover 200 plus data points. And the Quantum India ESG fund is based on this philosophy. The second important feature is the liquidity screen. So in these days, you have been hearing a lot of news where in the stress test which SEBI has mandated, the liquidity level of portfolios have been falling in certain portfolios, in certain funds. And the prime reason is when you build a fund, ignoring the amount of capacity it can hold. So any instrument in the world, be it an aeroplane or a bus or a car, it has a defined capacity. And as a manufacturer of the fund, it is important for you to understand what is the capacity which you can absorb. And some of the overvaluation which we are seeing in small and mid cap is a result of flows which has come in excess of what it could absorb. So here is the liquidity profile in terms of the stocks which we hold in Quantum Long-Term Equity Value Fund. Excuse me. So as you can see, almost 76% of the stocks we can liquidate, 76% of the market value of the fund we can liquidate within a day. And close to almost all the stocks can be liquidated in less than 3 weeks' time, and most of it within 5 days. And how would we look if we grow our AUM 10x? Here is a figure, but the liquidity is still retained. So this is achieved in terms of when we cover the stock, we ensure that there is a minimum liquidity, average trading liquidity over the past 1 year of at least 8.7 crores as we speak. And therefore what it helps is, even if we were to scale up the AUM, the characteristics does not change. We would still be able to replicate what we have achieved in the past the track record is replicatable even for future. And please note that this is calculated based on fairly conservative estimates of not more than 1/3 of the participation in any trading day, and not taking more than 66 trading days in terms of entering or exiting a stock. And the reason why we came out that 66 trading days is the average holding period, which we assume is about 5 years. And we don't want to spend more than 2 quarters of the time, which is a reasonable assumption, less than 25% of the time in entering or exiting the stock. And it has implications when markets turn volatile or when liquidity dries up out of the system. And this is a broad portfolio characteristics. Being a value fund, the PE is on a 2-year forward basis based on consensus Bloomberg estimates. It's at a discount to the index PE. The valuation is at about 11% discount to the index valuation, with an earnings growth which is not very different from the index, which means the price to earnings multiple, just if we were to view that in correlation to the earnings growth or the EPS growth the companies can have, is at a discount to the index. And in terms of evaluating any fund, so most often we have seen funds to be compared on a calendar year basis or a financial year basis, whereas market operates in cycles. And it is important to evaluate any fund in terms of its behavior in a bull market phase or a bear market phase. The bull market phase is when the market moves from bottom to its peak, and bear market is when the market would retrace back to its next bottom. So being a value fund, following value style, in a bull phase, how the fund should typically behave is it should capture most of the upside in the initial phase of the bull market. But when market turns irrational, when valuations goes through the roof and it's not justified by an equivalent earnings growth, a conscious value manager would start trimming positions where he believes the valuations are in excess, and that results in higher cash levels. So towards the tail end of the bull market, a value manager should ideally trail the index returns for the simple reason that the valuations are not justifiable from a value manager perspective. So what it does is most likely you would end up with higher cash levels at the end of the bull phase. And you are in a set of stocks which are less expensive than the broader markets. And when the bear market kicks in, the higher cash level helps you, plus the set of stocks which you are holding may not fall as much as the market, and therefore you are likely to outperform in a bear market. And when the next cycle comes, like the period from 2011 to 15, the trend is not different. We have backed fairly close to the index returns, but not fully captured it. But when the next bear market kicked in, we did phenomenally better than the index return for the 2 key reasons. One, we are valuation focused, and therefore our stocks fell less. Plus, we were holding higher amount of cash. 2016 to 20 is a period where we trailed the benchmark by a larger margin for 2 precise reasons. One, there was a corporate tax cut where many of our portfolio companies did not benefit because they were already at a lower tax rate. Many of them were into exports, which already had a lower tax rate, plus some of them were into regulated equity business, regulated return models where your returns are kind of fixed. So if your tax bracket comes down, you have to pass it on to customers. You may not benefit from that. And for that precise reason, the underperformance versus benchmark was slightly on a higher side. And the next bear phase was a very short phase. So typically what happens in a short bear market is fund managers tend to exit the large cap liquid names in the initial phase of the bear market. And therefore the large cap names could fall in line with the index. But if the bear market prolongs for a longer period, like we saw in 2015-16 or 2010-11. So when the bear market prolongs for a longer period, you would see some of those less liquid names seeing a larger drawdown, because as the redemption pressure keeps coming in, you would be forced to sell some of those illiquid names, which would lead to larger drawdowns in the broader market and those small cap names. And therefore, in such scenarios, you would see our outperformance kind of much outperformance is much higher than in a much higher quantum. So even in the current bull phase, which is ending with Feb 25, since the market correction has been quite narrow, we have not separated that as a separate bear phase. The performance looks reasonably good. So, but a lot of those outperformance has come up in the last 1 year when the markets turned volatile, when markets started respecting valuation levels to a larger extent. And here is the performance relative to other indices like BSE 200 and BSE 30. Our outperformance versus BSE 30 would look much better because it's a large cap index and we operate more in that liquid space because of our liquidity filters and our thrust on quality. And if we were to consolidate the performance, what we saw in the previous slide can be done with two key ratios. One is the up capture ratio, which measures your fund performance relative to the market when the markets are moving up, and the down capture ratio, which measures your fund performance in a down market relative to benchmark. If market moves up by 100, and if your fund moves up by 90, your up capture is about 90%. 90 divided by 100. Market moving up by 100%, the fund moves up by 90%, your up capture is 90%. Similarly, if the market comes down by 50% and your fund comes down by 40%, your down capture is 80%. And if over long periods of time for any fund to perform better than the broader market or the benchmark, you should capture a larger share when the market goes up versus how much you lose when it comes down. Or in simple terms, if your up capture is greater than your down capture, which means you're capturing a greater share of that bull phase versus how much you're losing in a bear phase, you're bound to perform better over long periods of time. And here is those ratios for quantum long-term equity value fund. Since inception, the up capture is about 87% versus a down capture of 76%. So like you can see here, most of the outperformance has emanated from a period when market turns volatile or market turns fearful, and therefore you would see larger drawdowns in broader markets. But the way we have designed the fund, the way we construct portfolio, our down capture is much better across periods of time. It takes 1 year period, 3 year, 5 year, 10 years, or since inception. This has been a characteristics which have stayed fairly strong. And this is reflected in our long-term track record versus index. And here is the up and down capture versus the other indices, which is the BSE 200, which is a large cap, which is a much broader index, and the large cap index. Of course, the numbers look relatively slightly better versus Sensex, predominantly because that is a space where we operate, and there is a little more higher froth in the small and mid cap segment. And here is our long-term track record. Like I said, in the last 1 year period, you would see that outperformance standing out because markets have turned volatile. And like Christy showed in one of our earlier slides, the drawdown is slightly higher in the small and mid cap space. And therefore that is helping us in terms of better outperformance.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.